The Commodity Channel Index, or CCI, is another useful oscillator that identifies overbought and oversold conditions. By using it, traders find good entry points to take advantage of temporary pullbacks during a bigger momentum, or exit points to realize their profit. The CCI subtracts the moving average from the price and then divide it by 1.5% of a normal deviation. But don't worry about the formula. Basically what you need to know is that it compares the current price to the average one over a specified period of time. The outcome is a number that usually, about 80% of the time, fluctuates around zero and within the range of minus 100 at the bottom and plus 100 at the top. However, sometimes it falls outside this range, and this is when it provides us with possible trading signals. In general, a reading above 100 considered to be within the overbought area, while a reading below minus 100 considered to be oversold. But the levels might change depending on the asset you trade on and the current market state. Now we will learn how you can use the CCI profitably with two trading strategies. The first one is the basic overbought oversold strategy. First, let's go over the principles and then we will see an example. As a general rule, relate to the minus 100 and plus 100 as the references for overbought and oversold areas. Similar to the RSI, look to trade with the direction of the current momentum, and in order to increase probabilities, wait for the confirmation that happens once the line returns from the extreme level back towards its averages. So you basically buy with the direction of the trend once the CCI goes below minus 100 and then climbs back above it. And on the opposite side, you sell with the direction of the trend when the CCI rises above 100 and then falls back below it. Now let's see how it works. Add the CCI to your chart. The default setting is usually 20. Keep it as it is. If it's not, then change it. As you can see in this hourly chart, most of the actions is happening between those two lines of minus 100 and plus 100. Let's test this part of the chart. First, we can easily see that the longer term direction is upward. We can confirm it in the daily chart. So in order to strengthen our signals, we will choose only the ones that goes to the upside. We will have a look at the oversold potential areas, and as you can see, when the line drops to the minus 100 to minus 200 area, it tends to bounce and go higher again. So we set our oversold level to be at minus 150, which seems to be the right level for this chart. And look how nice it worked. We can see a clear pattern, and every time the CCI fell into the minus 150 area, it bounced back and took the price higher within. Look how many profitable trades could be executed only by this method. Now we will talk about the second method, which is the divergence strategy. It is very similar to the one we used with the RSI, and it happens when the CCI line and the price behave differently. The bullish divergence happens when the price is making a lower low, however the CCI is making a higher low. It indicates that the down momentum might change now and it's a buying opportunity. In a bearish divergence, the price make a higher high while the CCI make a lower high, suggesting that the up movement is about to reverse and it might be a good time to sell. Let's see two examples from the same chart of how we could use divergence in order to execute profitable trades. First, look here. The price keeps going down, making lower lows while the CCI is making higher lows. The point where we want to buy is here, after the CCI went back into the average zone. We use it as a confirmation that momentum has indeed changed. That was a perfect entry point, as you already saw what happened next. And in the end of this nice up movement, we have a good example for a bearish divergence. At this time, after an extreme level of the CCI, the price went on to record a higher high, while the CCI went lower. When it got back into the brown area, we could sell, and indeed it was the beginning of a D line. So these were CCI strategies that can generate good results if used properly. Now it's important to note that in general, no matter which strategy you use, you should combine it with a good money management system in order to manage your risks. We will talk about everything you need to know about it later, so don't worry about it right now. Another thing that I'd like to say is that even though these strategies can work great by themselves, it's never a bad idea to be a bit more conservative and look for additional confirmations. It can be a candlestick pattern, volume, or other indicator that leads to the same conclusion.